Hello everybody, Stewart Heath here, founder and CEO of Harvard Grace Capital, back with another episode of our series 100 Questions You Should Be Asking Your Passive Activity Sponsor. We are in the section of the questions you should be asking the sponsor about the investment itself, detailed questions about the investment. We've already covered questions that you should ask the sponsor about the sponsor, but now we're talking about the specific investment that you are considering when you're looking at this. Be sure to go to our website and get this free book, and you can download that. And I think you'll find it really helpful as you're in your investing pursuits. So today we have 4 more questions. This is our 3rd episode on questions about the investment itself. Here's a question that I truly love. Which management company will run the asset, and how have they performed nearby? So not only do you have a responsibility to diligence the sponsor, you want the sponsor to have diligenced the management company, and if not, if you can't get comfort there, you should do that yourself. There are, like everything else in life, there are great management companies and there are not so great management companies. There are management companies that will be owned and operated by the sponsor. I can tell you that's the model that we choose, and management is, it's not a great business. There's not a lot of margin in it, but we choose to do it just because that's the only way that we can ensure that we can deliver the business plan that we have sold to our investors. So who the management company is critically important because they are the ones executing the business plan that you are buying into. Second question for today: how will you keep the tenants happy during any upgrade? So if you are investing in a renovation plan, and so tenants are going to be there, and a lot of the times this applies mainly to a multifamily deal, but not always. How do you keep them happy? Because nobody likes to live in a construction zone, but one path is to take all the units offline and not worry about current tenants and do all the units at the same time. Very costly. Usually you're relying upon that ongoing rent income as a part of your business plan, part of the economics. So you want to focus on how do you keep those people happy. Because if that's part of your plan and then you get a mass exodus of tenants, then your plan gets blown up. Third question for today: how did you stress test this investment with interest rate hikes and cost overruns? And how many different ways did you stress test this? That's just additional modeling. And how hard did you look at this investment as far as what can go wrong? Great question. Make them walk you through that model. And fourth question, last question for today: what are the exit options? Most people in our business will just say, all right, here's the projections. We're going to be a sale at the end of year 5, which hardly ever happens. What are the real options? Now, why do we pick year 5? Because it's a nice middle of the road, and because these are long-term investments. So generally your sale will happen either in year 4 up to year 7. And you don't want to sell too early, so you need to allow the sponsor the freedom to sell in the right market, because that will drastically impact your returns. But what are the other options? Is somebody going to come along and buy it if a market can't be found to sell the asset? Is the sponsor going to buy your units back? That does happen, and usually we like our properties so much that we're happy to buy our units back from our investors. But there are other options other than just selling it outright on the market. So there's you just want to have them tell you what all their options for exiting and getting your money back are. All right, those are our questions for today. Please keep coming back and watching. We appreciate you. Thank you.